Good evening, viewers. My name is Imran. I'm a UK and international tax specialist. Once again, I'm here with another interesting video. In this video, I will explain to you how you can calculate your income tax charge on provision of living accommodation by employer in the UK with illustration and example. So stay with me. I will explain to you in more detail. So this topic is highly tested in ACCA, ACA, and CTA exam. There are also useful information for employer and employee. The following slide will explain tax consequences of provision of living accommodation to an employee by the reason of his employment with illustration, which will make it very easy for the viewer to understand the concept and apply it in exam or practice. Remember, knowledge is a key. If you are knowledgeable and you understand the concept, you can easily apply that concept in exam or in practice. So if your boss asks you, if you're working as a chartered accountant, if your employer asks you that question, so you will be able to answer their question. Living accommodation, taxable benefit. If a living accommodation owned or rented by employer, so it doesn't matter, is made available to an employee or his family member by reason of employment for living, so this may be taxable benefit for employee. The reason for using the word may be because there is some exemption available in certain circumstances. It doesn't matter if employee living in it or not. The fact it is available to him is enough to trigger a benefit charge. Any household expenses relating to living accommodation that covered by employer will also result in a separate taxable benefit charge, even if the living accommodation itself is exempt. So remember, when there is exemption available in certain circumstances, as I said before, so in this case, if the employer pay for the household expenses such as heat and light, so this will result in a taxable charge, which I will explain to you on the following slides. Exemption from charge to tax. So the key exemptions are available. So there are exemptions available in certain circumstances. For example, accommodation was provided in connection with performance of duty. So definitely an examiner will be testing you, or it's good to know in the real life as well. So accommodation was provided in connection with performance of duty, such as provided to a security guard or a caretaker. So that is a common sense. If the accommodation provided is job related, that is, if it is necessary for proper performance of job, for example, a caretaker, because a caretaker without accommodation will not be able to perform duty in a proper way. So therefore, it is necessary for employer to provide such accommodation for a caretaker or a security guard. And then better performance, there's also that condition is necessary as well, and it is customary for employer to provide living accommodation to such employee. For example, an accommodation for a vicar with vicarage in the parish, for example, a priest in the church. So if the church provide a priest a living accommodation next to the church, obviously that is exempt. Living accommodation for director exemption. In certain circumstances, exemption is available for a director as well. So in this case, the director has no material interest. That is one, for example, the director should not own more than 5% shares in the company, and one of the following should apply, or the one of the following applies. The director is a full-time working director of the company, or the company is a charity company. Exemption continuing. Exemption is available if accommodation for employee provided because there is a threat to employee physical security. So that is obviously a common sense as well. Local authority provided accommodation. So in this case, if a local authority provide accommodation to their employee and accommodation on no more favorable terms than other local authority tenants, such as social housing, so this will be exempt as well. Exemption continued. Overseas holiday home owned through a company. A company wholly owned by a director, and that company owns an overseas property and such accommodation provided to an individual. So condition is that overseas property must be the company only main asset, and the company can have no activity other than those incidental to the ownership of the property. Now let's come to the main activity where the tax applies. So obviously you will be tested and you will be constantly asked this question. So we're saying is there is an exemption available, however, in certain circumstances, otherwise no exemption available. So what will happen if there is no exemption available? So let's come to the main topic. So now how to calculate, for example, there are various elements. So the first thing you need to look as whether the company owned the property, whether the employer owned the property, or renting it from a third party. So if accommodation rented by employer, a short lease less than 10 years, the employer does not own a property, so the cash equivalent will be higher of the rent paid by employer to third party and the annual value of the property. So choose the higher value first, and from there you deduct employee contribution. In certain circumstances, the employer may ask employee to contribute some money, so this can be deducted. Here is an illustration for the previous slides. So Mr. Alex is provided with a flat on 1st of July 2022 with no exemption applied. His employer leased the property for a period of 6 years commencing 1st July 2022. Employer paid a premium of 30,000 and pays the rent of 500 per month. Annual value of the property is 10,000. Calculate Alex taxable benefit for 2022-23 in relation to living accommodation. So remember, when there is a lease as well, so the lease will also form a part of calculation. So remember, in this example, the lease is for 6 years. So remember, you need to divide this 30,000 by 6 years and multiply by. And the other point to remember is because the rent or the accommodation started partway through the year, so make sure you do the proportion. So for 9 months, because in the UK, the financial year run from 6th of April and end on the 5th of April the following year. So I would explain to you how you would calculate on the following slide. The way you need to deal with this question is simply choose higher of rent paid by employer plus lease and annual value. So choose a higher value from these two. So therefore, so first thing is remember, the employer paid 30,000 lease premium for the 6 years. So 30,000 divided by 6. Don't forget to multiply by 9 divided by 12 because the rent, the provision of accommodation started partway through. It started from July. So therefore, in the UK, the financial year run from 6th of April and then end on 5th of April the following year. So in our scenario, it started on July. The living accommodation or the provision of living accommodation started in July. So therefore, we need to take only 9 months in account. And then obviously the employer also pay rent on behalf of the employee, which was £500 per month, and then only for 9 months because as we said it. So then in this case, you just add them up. It's very simple. And then the annual value is given to you, which is 10,000. So choose the higher value. Obviously, 10,000 is more than 8,250. So therefore, 10,000 worth of benefit to be included on P11D for Alex in 2022 and 23 year. Alex will pay additional tax on those benefits. Accommodation owned by the employer. So what will happen if the employer owned the accommodation? If the cost of accommodation is not more than 75,000, the cash equivalent. So in this case, now obviously previously the employer rented from a third party. So there's only thing is that the employer paid the rent to third party and then obviously the annual value. So choose the higher one. So in this case, when employer own this property, so there will be two elements. Number one is the employer ownership. The other will be is the annual value. So this can make things slightly complicated. However, not difficult at all. So if the cost of the accommodation is not more than 75,000, the cash equivalent benefit of the benefit is the rental value of the accommodation, less any amount made by the employee or employee contribution. If the cost of accommodation exceeds 75,000, additional charge arises at the rate prescribed for beneficial loans on the excess of the cost of providing accommodation over 75,000. So, for example, if the value of the property is more than 75,000, an additional charge would arise. That will be based on using the beneficial loan rate on the excess of the cost of providing accommodation over 75,000. I would explain to you with illustration. The amount of the benefit is reduced by any contribution by employee. Also remember, when calculating the cost of property, only those improvements done before the beginning of the year are taken into account. Any improvement during the year will affect the cost used in calculating the benefit for the period. Deduction is available for employee contribution. However, if the contribution exceeds the amount of benefit, no loss will arise. So, the employee will not be entitled for any tax refund. Simple as that. In summary, the calculation will be performed as follows. Annual value, as we said, because the property is owned by the employers. In this case, will be annual value plus additional yearly rent if the cost is more than 75,000 multiplied by the beneficial loan rate at the start of the tax year. So this will be given to you in exam tax table. Here is the illustration in case of accommodation owned by the employer. An employee, Alex, lives in accommodation owned by his employer. The employer bought this house for 200,000, has the annual value of 10,000. The employee pays the rent to the employer, £500 per month. Assume the official rate of interest is 3% at the start of the year. Calculate Alex's taxable benefit in relation to living accommodation for 2022 and 23. Now remember, as we said, the accommodation is owned by employer. So there's two elements. One is annual value. The other one is because the value of the property is more than 200,000. Remember, if the examiner states that the house cost to the employer is 200,000 and before providing it to the employer spent another 100,000 on the top. So you need to add those amount to the cost. Now, continuing with illustration 2, the solution will be, so first you need to start with the annual value, then add additional yearly rent. So that will be based on the cost of the property minus 75,000. So remember, we said that if the cost of the property is more than 75,000, this will result in additional charge, which is called additional yearly rent. So obviously the cost of the accommodation or the cost to the employer when buying this house was 200,000. So 200,000 minus 75,000 multiplied by 3%, less contribution paid by employee, which was £500 per month. So that is 6,000 a year. So that would be the taxable benefit to Alex will be 7,750. So this will be reported on Alex P11D for 2022 and 23. Another important thing to remember is highly tested and an exam. So that would be 6-year rule for the property costing over 75,000. Remember, in the previous illustration, we're saying if the employer purchased this property for 200,000 like several years ago. So that's why we use the cost to the employer. So in this scenario, what will happen is where a property is first made available for use more than 6 years after it has been acquired by the employer. So in such case, additional yearly rental is not based on the cost. Instead, the charge is based on the market value of the property. For example, employer bought this house for 200,000. However, before providing it to the employee, it was already owned by the employer for at least 6 years. So in this case, and now the value of that property, the market value of the property is 500,000. So you need to take into account 500,000. So that is what they're saying here. If this rule is used, the cost of any improvement between the valuation date and the start of the tax year for which the benefit is provided, less any employee contribution, should be added in calculating additional yearly rent. So the additional yearly rent will be based on the market value of the property if the 6-year rules applies. Now, this is illustration 3 explaining 6-year rule for the property costing over 75,000. An employee was provided with a house by his employer in June 2018. He pays £500 a month for use of the house. The house was purchased for 180,000 in 2010 and has annual value of 10,000. The house has market value of 250,000 in June 2018. In June 2020, the employer paid for extension to be added costing 20,000. Assume official rate of interest is 3%. Calculate the taxable benefit for 2022-23. Remember, this property is already owned by the employer for more than 6 years before providing it for living to their employee. So therefore, a 6-year rule would apply. So in this case, we need to take into account the market value of the property, not the cost of purchase of that property, and add any improvement. For example, there's a extension to be which was added costing 20,000. Now, illustration 3, that is for the 6 years rule. So you will start with the annual value, which was 10,000, add additional yearly rent charge. So that will be based on the market value. The market value of the property is 250,000. Add this 20,000, which was spent on extension, minus 75,000. 75,000 is the threshold, and then multiply the result by 3%, less any employee contribution, which was an employee was contributing £500 per month. So the taxable benefit that reported on P11D would be 9,850. Note, very important, if the market value of the property falls below the original cost, this rule still apply. This market value should still be used to calculate the benefit. For example, employer bought this property years ago and then own it for at least 6 years before providing to their employee, and there was bought for 200,000. Now the market value fall down to 150,000. So in this case, we will take into account 150,000. So the market value rules will apply. However, this is unlikely the case because usually the property value goes over the passage of time. Very important, household expenses. But before we talk about this, you should know what's a P11D form. So a P11D form is a form on which the employer report the benefit to the HMRC. So on this basis, the employer provide the detail of the employee that the following employee were given car, loan accommodation, living accommodation, beneficial loan. On this basis, the employee will be subject to any additional taxes and the employer will be subject to employer NI. There is no employee NI on provision of benefits. So at this topic, in this slide, I will explain to you household expenses. If the employer pay for gas, electricity, council tax, water charges, repair and cleaning, etc., or provides furniture or domestic appliances, this will give rise to additional separate benefit based on the cost to the employer. Separate rules apply for exempt accommodation. So remember, we're saying is accommodation provided to a caretaker. So the benefit will be restricted to 10% of his salary. For example, the caretaker salary is 30,000 a year. So 10% of 30,000 would be 3,000. If those household expenses goes over 3,000, we would keep it to 3,000 because the 10% restriction apply. However, the 10% restriction only applies if the living accommodation falls under exemption. Now, this is illustration for household expenses for exempt accommodation. As we said on the previous slide, because when a household expenses related to exempt accommodation, so there's a different rules apply. So in this slide, I would explain to you. Assume a vicar living in a vicarage provided by a church. The vicar has a salary of 24,000 and his employer pays for the heat and light, cleaning bill related to the household house costing employer £2,600 or 2,600. Calculate the taxable benefit for 2022-23. Remember, Vicar salary is 24,000, and remember the rule is the household expenses should be restricted to 10% of his salary. So in the following slide, I will explain to you how does it work. Now, I will show you how much vicar need to report taxable benefit. So, or the church need to report taxable benefit for the vicar. So, vicar salary is for the year 24,000. So, the amount on which vicar will be taxed cannot be more than 10% of his salary. So 10% of his salary is 2,400. However, the heat and light and the cleaning charges are 2,600. So therefore, we need to take into account only 2,400 because the charge cannot be more than 10% of his wages. So it's very simple solution. Additional notes. There is no taxable benefit on provision of living accommodation to vicar by church, as the accommodation is provided for the better performance of his duty, and it is customary for vicar to be provided with living accommodation, as the employer also covered the bills, which will give rise to an additional benefit. If you recall, we said this thing on one of the slides, so that is the main point. Thanks for watching. If you do have any queries or questions, you can drop me a line or two. This topic is quite complicated. However, you need to make a notes. After watching this video and going through the slide, I try to make it very easy for you so you can pass your exam, or in practice, if someone asks you any question, so you will be able to answer their queries. If you like this video, you can subscribe to my channel. I will be making more videos on the tax related topics such as corporation tax, capital gain taxes, other aspect of employment taxes, and then other aspect of sole trader, and also on VAT and inheritance tax, financial reporting, financial management, and performance management. Now I'm wishing you a very good night.